Hi, my name is Mike, and I'm the Chief Investment Officer here at Lighthouse Financial Services. I'm here today with a special market update for October 13th, 2022, and I'll show my screen and we'll get started. Okay, this week has been important for capital markets investors, economists everywhere. We got two inflation reports that came in hotter than expected. And this was bad news. Wholesale inflation, the shorthand for that is PPI, came in at plus 8.5% year over year. That's pretty high, down from August, but still that's pretty high. And then CPI, which is shorthand for retail or consumer price inflation index, came in at 8.2% year over year. So, these two measures of inflation have remained stubbornly high. Yes, they peaked a few months ago. That's pretty clear, but it's sort of as the Fed has been telling us, there's really no concrete signpost to point to showing that inflation is indeed falling at an acceptable rate. They want it to moderate, ideally back down to their target 2%, and we're a long way from that. So anyway, CPI is down from probably 9% down to 8.2 year over year, not enough. And so that's bad, obviously, for capital markets. I'll point out that food prices were up 11.1% year over year. That's quite a lot. Also, housing costs. We're now starting to really pay attention to that. Rents are still rising at a 7.6% clip within the CPI index. Commodity costs are lower, and like gasoline and I think used vehicles are also, the prices are also finally coming down. But services remain high, and like airfare. And so this is, again, like I say, this is not good news. When you have higher than expected inflation in this environment, it's going to, all else equal, encourage the Fed to continue raising interest rates, which is it's just going to happen. Now, the Fed already has a plan, but we can see this we can see that the plans for interest rate hikes might have to be raised yet again. The Fed funds rate is now seen rising to 4.8% by March, whereas I think before this week we were looking more at 4.6%. So is that one more rate hike? Something like that. The current rate is 3.25%. We know that the Fed is probably going to raise interest rates by 0.75% later this month, and then, excuse me, in November and also in December. But we may need further rate hikes to kind of contain inflation after that. Now, the bond market is saying, implying, looking at the trade in the bond market, implying that that rates will kind of gradually head lower after that for the next couple of years, which is great. But remember, the Fed's plan is to bring rates up to kind of what they call a restrictive level that sort of encourages people not to buy that next home or that next car, encourages businesses not to grow or continue hiring. They want it to raise rates to that level and then keep them high for a little while to make sure that inflation is indeed moderating. So let's take a look at the economy real quick. Part of the problem here is that core economic growth is fairly strong. I mean, we have bank CEOs telling us that still consumers' bank accounts are orders of magnitude higher than they were before the pandemic, and generally people are paying down debt and keeping more in savings. And boy, you got good hiring in the job market still. It's moderating a little, but still very strong. And what do you have? Well, you have a pretty strong core economy. And so this is why I've been telling clients, good news is bad news. When you have a great employment report, it's kind of bad news because it's encouraging the Fed to say, okay, well, we need to work harder to bring down inflation. But I think this script is going to flip from good news is bad news, and it's flipping to bad news is now good news. And I'll tell you what I mean by that. But first, we'll take a look at the path of inflation, and this sort of just highlights what I've been talking about. It just, inflation is very, very high. You can see where inflation was, both the headline, the black line, and then X food and energy is the blue line. But they both were pretty moderate to very low since the housing crisis. And but after after COVID and Fed stimulus, inflation has exploded higher, and we are still really waiting for it to come down in a meaningful way. So that's really the dilemma here. Let's take a look at the stock market real quick, the S&P 500. I want to point out that since the low of COVID, where the S&P 500's price was about 2192, and all the way up until the top at the end of last year of 4818 roughly, the market is now retraced half of that gain on the downside. So we've already given up half of that gain. And this is called a retracement. And a lot of short-term traders tend to look at technicals like Fibonacci retracements. It's just a fancy word for analysis that they run. And 50% is usually a pretty key level. So having today at the open, having dropped lower, the stock market sort of fulfilled that 50% down. And immediately afterward, sprang to life, and you can see a pretty high bar at the very end of this chart. We opened down, but ended very solidly in the green today. So it's a key reversal. And what I want to say qualitatively about that is that while we got a negative economic or inflation report yesterday and a very negative inflation report today, the market did nothing but hold its own and then rally. And so the script might flip here, where bad news doesn't beget more and more selling. Eventually, and at some point, you run into a place where selling sort of exhausts itself. And I think for now, that's kind of where we are. So that bad news did not bring a negative result. And we'll talk a little bit more about that in a second. But it is true. We're still in the middle of a bear market, and it's been pretty weak lately. And the S&P 500 is, this morning before it rallied was down somewhere around 27%. And what does that mean? Well, it means the stock market's getting cheaper across the board. And so this chart I've shown you before, it's the price earnings ratio on the S&P. And the higher this line is, the more expensive stocks are, and the lower it drops, the cheaper stocks are. And we're really back below a long-term normal level. Long-term average, something like 16, and we've dropped below that recently. This chart says 15.7 or 15.8, but the point is that you can't go down forever. That just doesn't happen, right? Unless you own a penny stock, maybe even crypto, I don't know. But with quality stocks, the S&P 500 is the 500 largest U.S. companies. It doesn't go to zero. Eventually, stocks get cheap enough where someone steps in and buys, even if that someone in the middle of an awful market in 2008 is Warren Buffett. Somebody's going to step in, right? So stocks don't stay cheap forever. By this measure, they are fairly cheap. And my opinion is that even if earnings estimates or profit estimates for next year get knocked around a little bit, the stock market is still not expensive. So I just want to highlight, by way of illustration here, with 6 stocks, that things are getting cheaper. Google, the company's real name now is Alphabet, but anyway, Google is down 31%. Domino's Pizza is down 40%. Target's down 33%. Procter & Gamble down 23%. JP Morgan Chase, the bank, down 31%. And Microsoft a huge tech conglomerate sort of software company, down 30%. All these companies are from different sectors, okay, different sectors or industries. And I want to just show you that although the stock market is down 25, 27%, there are plenty of really high quality, well-known household, what the people would call blue chip names that are down more than that. How much do you need Microsoft to be down before it's cheap? Does Domino's Pizza long-term deserve to be down 40%? Are these names going to zero? Are these companies going out of business even if we go into recession? No. Take Alphabet, for example. They have a pretty wide competitive moat in advertising and internet search. And if could this stock go down instead of 31%, could it go down 35, 36? Absolutely. It could do that tomorrow, in the next week, the next month, before the end of the year. It could do that. Is it going to zero? No, these companies are not going out of business. And so as stocks get cheaper, professional investors start looking for opportunities. And we think with this flipping of the script, remember, good news was bad news, and now we might be coming to a point where bad news is actually good news. We think we might be close to an opportunity here. And I want to highlight that with one more chart here. And that chart is just a survey. It's a survey it's done, I believe, weekly by AAII, and it's a survey of individual investors. And they ask them, so how are you bullish on the stock market, you know, in the near term here going forward? And at the moment, about 20% of respondents are saying that they're bullish. And I run this chart back to just before the financial crisis for a reason. You see the two red shaded areas are recessions, and the narrow one toward the right, that's COVID. The real fat one to the left, that's the housing crisis, a much more serious, from an economic standpoint, a much more serious meltdown. In fact, a near meltdown of the entire financial system. And I want you to notice that this year, this survey busted through those lows. And so, you know, I mean, we've been looking at multi-decade lows for this survey in terms of how people feel about investing. The R word, recession, is all over the news every day. And my contention is that it's not just individual investors, it's also professional investors that have been pretty bearish. I mean, our allocations in our client accounts to cash have been pretty high, much higher than we would normally carry. And you know, earlier in the year, we got rid of things that tend to be higher volatility, like mid caps, and certain sectors we de-emphasized that we felt like were going to take a bigger hit, like consumer discretionary. And you know, we're not alone. I think professional investors everywhere are sitting on a load of cash, and it's probably time to start looking for opportunities. Incidentally, professional investors, or traders rather, watch this chart, this survey, as a contrarian indicator. In other words, when it gets to very, very low levels, generally professionals look at that as a time to buy. And because we are at the floor, you know, how much worse can it get? The answer is not much. So I wanted to give you a reality check based on everything that's happened over the last couple of days. This comes from Liz Ann Saunders. She is Chief Investment Strategist for Charles Schwab. And in an interview today, she said, investing is not about getting in and getting out at moments of time. That's just gambling on days and prices. Investing should be a disciplined process over time. And she went on to mention that part of that disciplined process is asset allocation. In other words, how much do you put in cash, a fixed income or bonds, equities or stocks? That should be a disciplined process. It's our view that, you know, because we have been on the bearish side with that asset allocation, in other words, it's just more in cash, less in stocks, de-emphasizing even bonds because they have been not a great performer this year either. it's probably about time as the market cheapens up to get to neutral. And so, you know, we over the last a month or so, and then continuing over the next couple of days, we have and we will be making some changes. And what are those? Well, we've noticed that Treasury bonds, which used to yield terribly, I mean, it just pay you peanuts and you had to be locked in for a long period of time. Those have sold off to the point where you can get into a 6-month Treasury bill for approaching 4% yield. And that seems like a great opportunity because you know, the market's very volatile, and that includes fixed income. And to be able to bypass some of that volatility by getting into the T-bill, which is also incidentally state tax-free, seems like a decent deal to us. And you're not required to tie your money up for a long time at 6-month intervals or even a year. So we see that as an opportunity. And on the stock side, as I said, we're making an asset allocation decision to come off the sidelines and put part of that extra cash back to work in the market. And it's our feeling that we may not have seen the very bottom of this bear market, but we think we're at least very close. And our analysis suggests that even if you bake in, you know, some negative earnings revisions for 2023, we're still pretty close to what we think is fair value. And think about this: that list of stocks that I showed you earlier, are they going away? No. Are they going to recover? Yes. The only question mark is how long? How long does it take them to recover? Now we're a long-term investment shop. We don't need this advice that Liz Ann Saunders is giving us because we're not a trading shop. We're not short-term oriented. We have learned over the years that being fixated on a single inflation report or a single election return is often misguided. And so we're focused on the long term. And we believe that within a year or maximum 2, that, you know, the stocks that I listed on that screen and many more are going to be significantly higher than they are today. So I'll let you well, I guess I won't let you read the disclosures today. Anyway, there we go. Anyway, I want to thank you for being with us. And you know, if we come up with anything else that you need to know as investors, as clients of ours in the near future, we'll be back to you. Thank you very much.